Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 205th VideoCast podcast for the week ending June 12th, 2025. We've got a lot to cover today, but as always, family first, then we'll get down to business. That's Annabelle there. She set a new Novaquatics 9 to 10 girls team record in the 400 meter freestyle with a time of 4:42.04. She beat her previous record by 8 seconds at age 10. Ranks top 10 in the nation for 12-year-olds in both the 200 IM and the 400 free. Great job on that, Annabelle. Moving along. This was the Newport Beach TV Fest this weekend. Want to thank Carrie and Theo for hosting us there. You had Patrick Schwarzenegger, Arnold's son, was there. He's an actor in White Lotus. And Billy Bob Thornton from Landman. If you haven't watched Landman, that was a fun time. Also got to host Mimi's birthday. She's turning 13 this month at Great Wolf Lodge, which oddly I was very much looking forward to, because I think after 13 there aren't going to be too many more trips to Great Wolf Lodge. So we stayed an extra day and went down the crazy slides. There's Caitlin, Annabelle, Mimi having a fun day. Got to meet client Jake W. Thank you so much for coming in from Canada. Awesome time meeting you at the Four Seasons for lunch and just catching up and talking business and the podcast and everything else. Just really loved doing that. That was Caitlin and I, obviously the better half, standing with the blonde hair there. Also, Abdullah came in from and Obaid came in from Dubai this week. So we went to Javier's, and that's Chris and Kevin. Kevin is the cousin of Mike Lee, who you know from Fox Business. He's a friend. He's always on Mornings with Maria and Varney, and that's Mike's cousin, who also happens to be the former mayor of Newport Beach. Really awesome guy, and thanks for the Dubai chocolate for my kids, Abdullah. And Chris is a new friend, absolutely awesome. Thanks for hosting me at Balboa Bay today for lunch. Fun meeting Ed as well. And then I think that's, let's see if I'm missing anything. Oh, I didn't get a photo, unfortunately. Want to thank Keith and Damien for hosting us up at Baltair this Monday. Had a great lunch up there, also with Abdullah and Obaid, and just all around. And obviously, thanks, Mark. You know who you are, for hosting me for an incredible 18 holes at your beautiful club this week. And that is that. Let's get down to business, ladies and gentlemen. First one is, I want to thank Christian Dagger and Stuart Varney for having me on Fox Business yesterday to discuss general market outlook, etc. So we're going to listen in here.
To the markets, still plenty of green out there, but not that much. The Dow's up 30, Nasdaq's up 34. Tom Hayes joins me now. He's looking at the markets for us. You think the markets will go higher, make new highs this summer?
Well, Stu, I got good news for you. We are going to push to new highs. And all that means is we're catching up with the rest of the world. Many indices around the world have hit new highs. That means we could push over 6150 by midsummer before we get to the normal fall volatility and chop. And the reason is a couple of things. First off, the bar is set very low for earnings for Q2. They've taken it down from 9.3% at the end of March to just 6% right now. We did the exact same thing in Q1. We beat expectations. They were expected to grow 6%. They grew 13%. That's a good thing. Then you got all the trapped bears who sold in the hole. They didn't believe that Trump would pull this off. Well, we just got the biggest deal announced today with China. So this is a very constructive thing for earnings, for expectation, and for guidance. Remember, guidance was very cautious in Q1. I think CEOs are going to get a lot more confidence now they know the rules of the road moving forward.
We just got a couple of hours ago, we got the May consumer inflation report. Prices up only 0.1% in the month of May. Should the Fed lower interest rates?
I think President Trump is correct. We're going to have a situation of too late Powell. They claim that they are data dependent. They are prediction dependent. They are predicting that prices will go up from tariffs. Now we know what tariffs are. It's simply not going to be the case. We saw it in 2018. And President Trump is calling for a 1 percentage point cut. We're actually 150 basis points too restrictive, meaning the Fed funds rate above the rate of inflation. This is the fourth consecutive month in a row inflation has come in below expectations. It's time to start cutting. There's a 68% chance it went up this morning of the first cut in September. That probably needs to move up to 80%. They should do 25 basis points in June. They won't do it because they're in the prediction business, not the data business. They should be in the data business too, but it's all going to be okay. The economy is strong.
If they did do it, the market would be very happy to see that, a cut in rates in June and July. Tom Hayes, thanks for joining us. See you again soon.
Thanks for having me.
Still ahead, Trump's.
And we're back. And then on Friday, I had the pleasure to join Nicole Petalides on Schwab Network. Want to thank old friend Allie Thompson for putting me on. We covered a lot, covered 3 or 4 names in this and a key theme going into the second half. So we'll listen in here.
Welcome back to the Watch List. Our next guest, Thomas J. Hayes, Chairman and Managing Member of Great Hill Capital, joins me. Actually has some stock picks for your portfolio as well. What did you think of the week that was? I do want to talk about some of the earnings that you had on your radar for different reasons, but how do you think market's behaving?
Yeah, I think this market wants to push higher, Nicole. I think you have still a lot of trad bears who sold at the exact wrong time in the beginning of April. Over $1 trillion of hedge fund and CTA money got flushed the day before Trump put out his tweet. Now is a good time to buy. So every bit of good news, and we've had good news, 13.3% earnings growth for the quarter with 98% of the companies that had reported. That's up. Instead of expectations, we're at 6%. And we're going into the next quarter with reasonable expectations. So I think on balance, this market wants to push higher. The jobs report was interesting considering the Beige Book talked about a slowdown in labor demand and a slowing in the economy. I think that kind of surprised the market to the upside to see some strength. But the trend is down. The Fed will still be in the market cutting at the back half of the year. Right now, it just seems unclear whether it's going to be 1 cut or 2 cut. You still have a 63% chance of 1 cut in September. So I think a lot of good stuff and a lot of powder on the sidelines. So as this thing pushes higher, people are going to be forced in, and particularly those who sold low, missed the recovery, and now have to chase to save their careers.
Understood. Yeah, if you sold in April, you are not happy today. That's true at the bottom, right? You only lose money until you actually sell. You have a few names like Lululemon and Broadcom on your radar as far as earnings. What story do they tell?
Well, Lulu, I think the surprise there was that they were blaming the economy, saying that U.S. consumers are being cautious and intentional. That seems a little suspicious in the sense that you're seeing a tremendous amount of competition from Aloe, from Athleta, from other companies coming to bear. So they're blaming the economy. They're blaming the consumer. Their comp store sales were up 1% year on year, which was a little bit anemic. And they brought their guidance midpoint down from, $15.05 of earnings this year down to $14.68. So the market didn't like it. It flushed it down 20%. This is a high quality business, but the concern is that they're now saying they're going to raise prices due to the tariffs, and that's going to impact their margins by 110 basis points for the full year. So declining margins, slow comps year on year, and the market just completely flushed it out. As it relates to Avago, they beat as well, but the guidance was less than very high expectations, and it was a sell the news event. It had rallied 30% into the print, so people took some profits. The AI related business was up 46%. The non-AI related business was a little bit anemic. People were a little bit concerned about that. Free cash flow still strong, buyback still strong, but the stock taking a breather.
Yeah, understood. So right now, if I look at AVGO Broadcom, it is trading down about 4%, but has been a winner. 1 year up 87%, and just in 1 month up 22%. You have names that you like: Albemarle, QXO, Stanley Black & Decker, and also Generac. Is there a theme between these picks, or they each have their own story?
Well, I'm known as Turnaround Tom, so I like businesses that are out of favor, that are going to recover. Materials is expected to have the second highest earnings growth in 2026. We want to get positioned ahead of time. They're going to have 17% earnings growth. Albemarle, big player, number one top lithium producer in the world, lowest cost producer, some of their mines in Chile. And lithium is a very cyclical business. You see it throughout the years, even before EVs. They have ample liquidity to make it through the oversupply in the short term, which we expect to rebalance in mid-2026. The operating leverage in this business is second to none. Once lithium rebalances as the smaller players shut down production, Albemarle is going to be the big winner. And as we're going to see, demand from 1.2 million metric tons last year to 3.2 million 5 years out, they're going to win. The whole EV story is all China. It's an unnatural subsidized government market in EVs. There's 60% of global EVs. That is not going to stop anytime soon. The Chinese government's going to keep pushing EV, which is going to benefit Albemarle as their competition goes out of business. They'll be last man standing, and they are going to mint money like it's going out of style. This stock is down huge. It can be up double to triple over the next 3 to 4 years. We think this is a huge out of favor cyclical opportunity, that this happens every 5 to 8 years, and we are buying it at the trough. As it relates to housing, also out of favor. Why? Because of higher rates. Rates are going to come down. Why? Besant is focused on the SLR. He's going to reduce capital requirements, which will create an enormous amount of demand by banks for treasuries. They'll be back in the market in a big way. And then you have the genius, and he said that'll lower 10-year yields, which is what mortgage rates are based on, by anywhere from 30 to 70 basis points. Then you have the Genius Act. Stable coins could be approved, where you're going to see right now the market for stable coins, which are backed by U.S. treasuries, is about $250 billion. That could go up to $2 trillion over time, creating $2 trillion of new demand for treasuries, which will bring yields down on top of it. So that's going to be very positive, because mortgage rates are priced off the 10-year. So I think the second half, you're going to see a 30-year fixed mortgage. You can timestamp this. We're going to see a 30-year fixed mortgage below 6% before the end of the year, and animal spirits are going to be back. New housing starts. The federal lands are opening up from this administration. It's going to create a lot of land, believe it or not, in metropolitan areas to bridge the 3 to 4 million unit housing dearth in the U.S. and the huge demand from millennials. So how do we play it? We don't want to play the warring factions. We don't want to play the home builders that are going to be producing and a race to the bottom as their margins contract, as they fight each other on price. We want to take advantage of the arms dealers like QXO, which is Brad Jacobs' company. It's a building supply roll-up. They started with Beacon Roofing. He paid 11 times EBITDA. He's going to double EBITDA over the next couple of years through implementing technology like he always does. Do a roll-up. If you follow what he did in XPO Logistics, you made 50-something times your money. If you follow what he did in United Rentals, you made 70 times your money. I think this is going to be a 5 or 6 bagger over the next 5 to 7 years, even from these levels. And even today, Wolf Research was out upgrading the stock. It's whatever it is, 17, 18 bucks, up to $44. We think that's a little premature, but it's definitely going to get there and more over the next few years. Then you got Stanley Black & Decker. If you're going to build houses, you need tools. Craftsman, Stanley, DeWalt, etc. They have been recovering margins after the COVID overstock. They've destocked. Now they're restocking, increasing margins. The last time they got margins up to the level that management is guiding by 2027. They earned $8 a share in earnings. The stock traded north of 150. Right now, I think it's trading at $65. So there's huge upside over the next 3 years. And then finally is Generac, way to play the housing recovery. Also interest rate sensitive because a lot of people finance home standby generators. They've got 75% of the market. They are going to fly. This stock is still down 75%, even though it's generating record free cash flow. Revenues are recovering. Their commercial and industrial business is improving. There's going to be a lot of backup energy and storage for data centers. That's going to be a monstrous business in addition to the home standby. And we're entering hurricane season. So other than that, how was the play, Mrs. Lincoln? We've got a lot of stuff here for you, Nicole.
All right, you really do. And Turnaround Tom, that's a good nickname. And it's fun taking a look at those key names, too, of Albemarle, QXO, Stanley Black & Decker, Generac, and more. Thank you, Thomas J. Hayes, Chairman and Managing Member of Great Hill Capital. Thank you, Tom. Coming up.
And we're back. Then I want to thank my old-time friend who gave me my first break on TV, Ellie Terrett. She was a producer, NYSE floor producer for the Clayman Countdown, put me on for the first time in 2019. Now she is the crypto cat queen. She always posts pictures of all of the cats she saves, and she is doing an incredible podcast, Crypto in America. She hosts all the major crypto events. She is the go-to in that space. And she quoted me in her article on stable coins this week. You can follow Ellie on Twitter if you don't already do it. If you have any interests in crypto or digital assets, she is the follow. Just put in Eleanor Terrett, Terrett. It'll come up. Then finally, want to thank Sam Clark and Hannah Mullane for having me on the BBC World Business Report with Rohan. It was more general questions about Elon Musk and about Disney's lawsuit against the AI company and such. So there's nothing really actionable. So you can listen to that on your own if you want to hear me talk general news. Have at it. And then quotes of the week, Warren Buffett, whether we're talking about socks or stocks, I like buying quality merchandise when it's marked down. No question, that's what we do here every week on Hedge Fund Tips with Tom Hayes. Also, Buffett says we enjoy the process far more than the proceeds. If I remembered that as much in golf as I did in investing, I'd be a lot more successful in golf. But it comes and goes. I had a tough round this week, but coming off a couple of weeks that were a bit stronger. So we'll see. I think all the pieces are there. We got to just get that break in 80 done. I know those of you who have been following along, been trying to do that for about a year. Let's see if I can get it done this summer. Rob Arnott, in investing, what's comfortable is rarely profitable. So we're going to talk about some of that this week. Also want to acknowledge a lot of you had asked for merch for Hedge Fund Tips, the super fans who have been with us for 6 months, a year, 2 years, 3 years, 4 years. And the response has been overwhelming. Thank you for the orders. A little bit more coy with the photos. So when people do send in photos, we want to acknowledge them. And you can see them right here when you click on number one hedge fund podcast. Also, while you're there, click on terms. This is all opinion, not advice. Consult your financial advisor before doing anything. And a couple new ones we haven't covered. John Martin, great picture with his mug right there. Love it. Price is what you pay. Value is what you get. And I think we covered Mike last week in front of the Van store and a lot of great others over the past weeks. So wanted to cover data now. QXO, a lot of companies have been coming out. We've been pounding the table. Did we get it? We didn't get in on the private deal at $8 or $9, but we did get in at $13 a while back. People were very skeptical because we paid a premium to cash. Now it's almost getting close to well, not a double yet, but it's up 65% in the last 2 months. Now Baird was out. Wolf came out and upgraded it to $44 a share. It's currently just over 20. Now Baird came out at $32 a share for all the reasons that we've been saying for months. And both when it was at 13, then it went down to 11 against us. Going back to Mr. Arnott, what is comfortable is rarely profitable. So you say, well, what's the big deal? You bought it at 13, it went to 11, but now it's over 20. And it's going to 100, by the way, over the next handful of years. But most people aren't willing to do that. You know, they don't know what they own, so they set their 8% stop loss and they miss all the multi-baggers, guaranteed. So that's that. And then let's go to some of the Slumer slides from RBC. By the way, the 10-year yield today, I think, was down to 436. So it's moving in the direction we've been talking about, in line with the housing theme, which we're going to spend more in the article of the week. So this is just a couple days old. It's already stale, 479 to 436 or something and change. I just looked at it. And that's going to help a lot of our positioning and what we're set up for. Here's the all-time high, 61.47. As I said with Varney, we are going to likely exceed those before the end of the summer. If we take a couple week break here, a little chop in the meantime, don't lose sleep over it. There are so many trap bears that's going to force this thing up to new highs. And then in the fall, maybe we'll get a little chop. But for now, when the music is playing, get up and dance. And we've been certainly dancing this quarter like nobody's business and been super happy about that. And kudos to all of you who came in when we said to come in, and all the existing who added money when we had to add, when we told you to add money, which was the first time in 2 years that we said add money now. And I will say, as much as you look at the portfolio and see all your positions up and smile so wide you could eat a banana sideways year to date and quarter to date, go through each of the names and you'll just see how much more opportunity is yet to come. It's literally just getting started. So all right, so that's more on the S&P. Small caps, this is going to be the next big money maker. Already made a big move off the bottom. This is also going to break to new highs. And then once it does, you're going to get yourself a measured move, which would be another 800 points to 3,200 on the minimum. This is now where the opportunity is. Skate to where the puck's going. Highest short interest in history. Get yourself some small caps, ladies and gentlemen, and they're going to rock. Oil's starting to get some bubbly. We continue to see Comstock Resources, which you guys all got in with us at $8 and $9, now at 25 and change. It's still got room. It'll probably take a breather in the next few weeks, but don't be phased out. The intrinsic value is higher, and we're excited about that one. Moving along. Goldman Sachs equity sentiment indicator is still subdued. There's still light positioning. There's still going to be people forced in or career risk. They sold at the lows. They're going to have to continue to buy up. I like this chart from All Start Charts. If small caps are about to enter a fresh period of outperformance, wouldn't this be a logical place to start? Historically, every major bull run this century saw small caps lead, usually nearing the beginning. Take a look. And again, we've emphasized so much over the last 6 to 9 months the parallels to 2001 to take advantage of. And now if you look at small caps versus large caps at this extreme multi-standard deviation move in relative undervaluation, and I'm telling you, if you missed everything and you were skeptical of the trade and you got shaken out by the tariffs because you weren't listening to the podcast when we said buy everything 8 weeks ago, or 6, whatever it was, the beginning of April, then you still have opportunity. I mean, we've had existing new money come in materially, and new clients are able to send in money whenever they want, and they do just recently. And I had no problem putting lots of money to work, even at these levels, because it's not the general indices. We're not in the Mag 7. So even if you say, well, it's overvalued, the names that we love will be overvalued in 12 to 24 months. They are opportunities of a generation right now. Even though a lot of them have moved up off the bottom, they're nowhere near intrinsic value. So if you're sitting on your hands or you've had liquidity events, get after it. This is not a time to snooze, because the train is leaving the station for damn sure, in an aggressive way. Next, monthly average returns based on whether the dollar increased or decreased in value that month by various asset classes. So you can see In a dollar down month, value did really well, small caps did really well, international did really well, commodities, emerging markets, etc. And that's what we are focused on. The dollar continues to weaken. For those of you who've been with us for over a year, you know we've been saying it's coming, and here it is. It's coming a major way. Emerging markets just starting to take off. We're excited. We expect U.S. power markets to get critically tight over the next few years. That helps our Comstock resources. S&P 500 companies with next 12 months earnings growth above 25%. Well, ladies and gentlemen, I hate to say it, only one Magnificent Seven company fits in that list, which means if you are overweight just indices or passive investing or Mag 7, you are going to underperform. We had been warning about that for a while. Yes, they will trade back up to the top of the range. No, they will not dramatically outperform that because their earnings growth is collapsing from 27% in Q1 of this year to 10.2% in Q1 of next year. Unmagnificent 497 going from negative to Unmagnificent 493, i.e. the rest of the S&P that's not Magnificent 7 is going to exceed the earnings growth of Mag 7 for the first time by Q1 of next year. So basically 2 more quarters out, the other 493 will have higher earnings growth than the Mag 7 and trading at half the multiple. That's where you want to be. That's where tons of doubles and triples are going to be made, and you're going to participate. Scheduled additions of solar, wind, and natural gas effective power generation capacity in Mid-Atlantic region are not expected to offset coal and other retirements, while power demand is expected to grow significantly. What does that help? Natural gas. What does that help? Generac, backup generators, not to mention the different climate events and hurricanes and everything else that's happening that requires, and the old unstable grid. So monthly payroll growth, you saw past revisions downward. The key is to look at the trend. The trend continues to go lower. The Fed will have to cut. I continue to think we'll be 2 times this year, down 50 basis points, plus what Bessent's going to do on the long end of the curve, which we're going to cover later. This is interesting. More and more firms are upgrading BABA now. HSBC Global Research published a report stating that the Ministry of Commerce's International Trade and Economic Cooperation Research Institute estimates that by 2030, instant shopping will bring a domestic incremental market opportunity of 2 trillion yuan. Alibaba plans to actively expand its market share, fully leveraging the strong relationships between Taobao and brands and merchants, Ellie Mae's delivery network and algorithms, as well as third-party operational data. Ellie Mae and Taobao have achieved 40 million daily orders for food and other instant retail compared to JD's only 25 million daily orders. The firm maintains Alibaba buy rating and target price of $176. That's just for starters. Once we hit 176, they'll be taking their price targets up to 225 plus. Median S&P stock short interest as a percentage of market cap is elevated. You can see here at 2.4%. So that's going to continue to be more pain. At the lows, no one was short. At the highs, at the lows during COVID, no one was short. This is moving up, and very similar thing you saw after the 2000 trough, and you had a massive bull market in small caps, international, and value over growth during that period. Again, just one more data point in the mosaic that we've been covering for 6 months, pointing to what's already started to happen, which we had said when was unpopular. International would dramatically outperform domestic. That has happened in spades year to date, and value would start to outperform growth. That is happening, and small cap will start to outperform large. That is on its way if you missed the first 2 trains. 4-week average in share buybacks versus the S&P 500. You can see share buybacks nearing a record, announcements at a record, and this is stuff that you start to see off troughs like you did in 2020. And then again, following the lows in 2022, when you couldn't give away Amazon and Google, we were buying it hand over fist. Those were easy doubles. And now we're seeing it again after the most recent tariff trough. And people are skeptical the entire way up. They will be skeptical this whole way up. Next stop after we hit, I think we'll probably hit new highs before we get the next major pullback. We'll get everyone sucked in at 6150 probably towards the end of July, and then August and September will probably rip back down below 6,000 to scare the hell out of everyone before a fourth quarter final rally. Dollar performance continues to weaken, both structurally and seasonally. That's going to continue through summer. That should continue to help emerging markets. Corporate buybacks, year-to-date share repurchase program authorized, $717 billion. We've never seen anything like it. Continued bid in the market. Global equities allocation and flows. China is starting to now tick up from despondency to apathy, and from apathy we'll go to comfort, and from comfort we'll go to euphoria, and we're probably 18 months out from euphoria. Earnings growth estimates are soaring for Chinese stocks, not for US stocks. Look at this. And if you're listening versus watching, I strongly urge you to go to the youtube.com, type in hedge fund tips, and pull up episode 295 so you can see all these charts and visualize what I'm talking about here. Revisions to forward 12-month earnings per share. China tech is off the charts, 15%. US anemic at 0.5%. Central banks cut rate at fastest pace in 2025 last month. That is global liquidity. You're seeing money supply now retake. M2 money supply is now higher than it was in April 2022. It took 3 years to get back up to increasing money supply. That's liquidity. Stocks are going higher. And the U.S. will follow suit. Too late, Powell is probably going to be too late, but they'll catch up. So why? By the way, I loved what President Trump said today. He laid out the reasons why Powell should cut a full 100 basis points. I've been saying that they're 150 basis points too restrictive above the inflation rate, which you saw both the PPI and the CPI come in below expectations for the fourth consecutive month in a row. And Trump talked about the $300 billion of interest savings for every 100 basis points or whatever it is. And that probably gets you a lot further than the Doge cuts. But the second thing he said is lower them now if you're, be data dependent, not prediction dependent. And if you're right and inflation does go back up, just raise them. It's much easier to fight off inflation than deflation. Deflation is a spiral you can't break. And once it starts, it's very, very hard to re-stimulate and costs a lot of money. But inflation, if you're wrong and let's say he cut 50 basis points and the tariffs kick in and inflation goes up to 3.5%, and they wait a few months and it's not coming down, then just raise rates 50 basis points. It's not a big deal. It's much different than if inflation goes negative, then you're toast. Then you can't bring back that sentiment. You can't bring back that confidence, and it's years of lost jobs and et cetera. And if you look at that unemployment trend, or the jobs creation trend is going down, and it's better to get ahead of the curve because of the lag of the activation mechanism after you take the action takes 6 to 9 months. So retail purchases of Mag 7, interestingly enough, retail has been right since COVID. And interested to see. They were buyers in the hole at the end of 2022. And they're not buyers now, and I think they're right. I think you get a trade to the top of the range for Mag 7. Everything else is going to be where the money's made. Small size consistently outperforms in June, so we'll see if we get follow through on the small caps. Share of first-time home buyers has declined from 50% to currently 24%. And that's what Powell doesn't get. Powell's being very narcissistic in his decision not to cut because he, quote, doesn't want to be Arthur Burns. So he's struggling with his recency bias when it's comparing apples to oranges, and the conditions and the demography are completely different than the 1970s when Arthur Burns was operating. And he's so concerned about his legacy that he's completely screwing over 75 million millennials who are trying to start a life and can't afford housing because of Jay Powell, because he screwed up so much on transitory. Now he's screwing so much on inflation is coming back that these people aren't able to buy starter homes until they're in their mid 40s. And the poor kids have to grow up in apartments and condos versus running around on the lawn when they're 3, 4, and 5 years old. So start thinking beyond yourself, Mr. Too Late Powell, and start thinking about the bulk of the population who needs affordable housing. And the irony of what we're going to see this time, believe it or not, even if Powell doesn't do it, Bessent's going to do it, and we're going to talk about how, is that when rates come down, okay, historically, houses almost trade like a bond. As rates come down, the prices go up. As rates go up, sometimes the prices come down. This time, I think it's going to be the opposite. As rates come down, you're going to see such an abundant supply hit the market all at once that houses are going to come down. So not only is the interest payment going to come down and the mortgage rate going to be below 6% on the 30-year fixed, but the amount of supply that's going to come on the market and the amount of building that and housing starts that's going to spur is really going to help out the millennials. And, I've already, I'm not a millennial. I know people say I look young. I've already got all the houses I want. I'm talking about the economy. And if you want a healthy, growing job, massive economy, you want housing to do extremely well. And it just ain't going to do well until Powell gets his act together and starts 1, 2 cuts, and Bessent will do what he has to do this summer. So hopefully this message lands, because it's not about one person's legacy. It's about 75 million people who need affordable housing to start families. And if we don't have family formation, this country is going to be like Europe in 10 years. So we got to rock and roll. And by the way, and not to pick on one guy, we need immigration. Hello. We need legal immigration, but we need material immigration legally, but open and aggressive to keep the population growing, to keep our global hegemony, economic hegemony, and the American dream humming. The capitalist formula requires population growth. So if we're not going to get it from birth, let's get it from legal immigration. And if rates come down and people have hope they can start a family, maybe you will get it from birth as well, which is the best. 1 year change in active housing inventory for sale. It's starting to come up. It will do better as different actions are taken that we've discussed. Annual buyback executions are just about $1 trillion year-on-year growth, 5% year-on-year growth. That's very, very constructive. Non-farm payroll growth, it was healthcare driving the bus in the most recent report. Realized and consensus EPS growth for select U.S. equity indices. This is another one you need to stop the recorder and go look on YouTube, because the Russell 2000, everyone's looking in the rearview mirror at small caps, which had negative 14% earnings growth last year. This year, it's going to grow at 23% earnings growth versus the S&P at 7%, and the multiple is less on small caps than it is on large caps. And next year, 2026, small cap earnings are going to grow 37% compared to the S&P at 14%, and the Mag 7 at 10.2%. So this is, price is what you pay, value is what you get. If you can get 37% earnings growth for half the multiple of something growing at 10 or 14%, that's where you want to focus your efforts, just like 2001 through 2007. City Earnings Reversion Index hit the highest since 2021 as of the last update through May 30th. So we're starting to get positive revisions once again, which is typical during this seasonal part. Usually you get the negative revisions through Q2, as we were talking about, and then they start to inflect. Retail slowed down in May with the net monthly buying dropping to 23 billion. So they were buyers in the hole, and they've been right. Now they're slowing their buying, but they're hodlers, and we concur. Welcome to a new bull market. More reasons for bulls to smile. New bull markets start 20% off bear or near bear lows, and what happened next. So we've just had that rally off the bottom. 12 months out, you're up on average another 18.9%. Firms are talking about the National Reshoring Initiative. We're seeing the manufacturing. So that's starting to come back. That explains it. 69 degrees in here. Okay, moving along. Foreign investor net purchases of U.S. equities. So that's gone down, and I think part of that has to do with the Mag 7. They were overcrowded in the same exact trade, number one, and now they've got currency risk because the dollar has been declining so quickly. So you're going to continue to see that outperformance, and that's one of the reasons on a micro level, being out here in Orange County, I've been talking about, I think you're going to see the high end start to get hit because that Chinese marginal bid that's been buying a ton of Orange County for the last few years while things have been bad in China. As China is starting to recover and you see the earnings growth and you see the market starting to go up and you see the government changing their policies, the cost to get capital out is so high and the friction and the risk that while it was worth it in the last 3 or 4 years when the government was being irrational, now that the economy is growing again, the opportunities to earn and earnings growth are much higher, that you're going to see that marginal bid into U.S. real estate in Orange County probably collapse, which is going to be an air pocket, particularly at the highest end. I think the 3s and 5, and I know it sounds funny to say the 3s and 5s, the smaller houses at 3 and 5 million in Orange County will be fine, but the 15s and 20s, I think we're going to start to see turn into 7s to 10s over the next couple of years, and that's going to create a lot of opportunity. But S&P intra-year declines versus calendar year returns. Okay, so you can see here, despite average intra-year drops of 14.1%, and this year I think we had 20%, annual returns were positive 34 out of 45 years. Upside chasing evidence in Russell 2000 options. So more of what we said was coming. Those who shorted in the hole, which was $1 trillion worth, now have to chase up. Now they're trying to catch up with options. You can't make this stuff up. And when the dealers sell options, what do they have to do? They've got to buy the underlying stock, and it creates a little bit of a gamma squeeze situation. And that's why I think we go to new highs before, by mid to late July. Percent of Russell 2000 members above the 50-day moving average back to 80%. So we've gone through the mill. Now the game is on, and people say, well, it's overbought. No. When you see huge corrections like that, you always see these overbought conditions continue for a long time after the initial recovery. And it's the catch-up trade becomes so massive. We saw the exact same thing in COVID in 2020. Market traded back up. Everyone was waiting for a leg back down. It's overbought. It kept going for another year and a half. S&P short interest, a rocket ship higher. Multi-year highs with S&PX, only 2% below all-time highs. Short interest represents future buying power. With squeeze situations increasing during rallies, melts up in SPX should not be a surprise given short interest. So much for hedging. So there is from Seth Golden, and you can see short interest exceeding the index here on the overlay, and that is the formula for continuation higher. Just people caught on the wrong side of the boat. Consumer sentiment often diverges from consumer spending growth. So sentiment is at a trough, just starting to turn up. Consumer momentum wanes on falling gas prices and buying ahead pullback. buying ahead of tariffs. So maybe you'll see a little bit of Q2 softness. Earnings estimates surpass prior highs, back up to 280. So we were 279 for the next 12-month projection right before the Liberation Day. Then it collapsed down to 277. Now it's back up to 280 for 12-month forward. So back at a record high. That's positive. Buybacks continue to go up. After 2-month gains of 20% or more, 12 months out on average up 30%. That again is from Ryan Dietrich. Consumers expected change in year ahead inflation rate. In May, the New York survey versus the Michigan survey, big divergence there. That blows with the wind. Fundamental long-short ratio. They're massively short in the hole, so now they've got to play catch up, and there's a lot of buying power that needs to still come back in. Russell's looking very good on a technical basis. Record short interest even after this huge rally off the lows, which is fuel to continue the trend higher, back up to new highs. That's an enormous opportunity, ladies and gentlemen. A lot of new money has to go there, and we'll continue to participate. Market value of bonds as a percentage of the market value of stocks. This is from Paulson. Total marketable securities for all sectors of the U.S. economy. Wow, that's interesting. The implication here is the value. Yeah, I 100% see this. The value of bonds going up, which would be in line with rates coming down, which will lead to two things. Number one, price going up across the board and a lot more issuance and refinancing at better rates. So again, Powell's holding everything up because he doesn't want his book to be entitled Jay Powell is the next Arthur Burns and screwing the whole world while he focuses on his legacy and his predictive powers of what he thinks inflation is going to do, what he thinks tariffs are going to do to prices versus being data dependent and based on right now acknowledging, oh, I'm 150 basis points above neutral. Why don't I get to neutral? And then if inflation becomes a problem, I can always do a 50-point hike to cool it until it works through the mechanism. But instead, it's all about him. It's not about the country. It's not about the 75 million millennials who can't afford a house and start a family. Next week, I'll tell you how I really feel. Natural gas consumption in the electric power sector continues to grow. Natural gas spot price trending up. Credible returns despite stumbles along the way. Oh, this is talking about drawdowns from peak since 1985. And that's that. Stable coins are mainly backed by liquid assets, i.e. T-bills and money markets. Money markets are also a lot backed by government guaranteed securities, reverse repo, and other. So that points to our view on stable coins driving another $1 to $2 trillion of demand for Treasury over time, which will also have an impact on compressing yields, help us refinance, help the millennials, et cetera. Year 3 of bull markets can be choppy. We're technically at the beginning of a new bull market if you count the intra-year 20% drawdown that we had in April. This you kind of have to back up. Crypto stablecoins market cap now 260 billion. And if they get this Genius Act through, probably going to $1 trillion to $2 trillion. Weaker dollar should be a material tailwind for earnings revisions breadth. This is an important point in the second half that no one's really put into their models yet, is that the weak dollar is going to help earnings as the S&P 500 get a meaningful amount of their earnings from abroad. Disney, so what was a headwind now becomes a tailwind. Disney's now making even more from its theme park business than everything else combined. That is staggering, 59% of the profits. CPI month on month with new vehicles, so the incentives are starting to kick in. That's good for volumes. You'll see that again in the second half, even though you had a little pull forward for tariffs. Used car and trucks. This is why we always wanted to play the arms dealers, not the warring factions. The OEMs will continue to be a race to the bottom in terms of margins. The suppliers like Cooper Standard that are indispensable and have unique technology will start to do massive volume numbers, which will go straight to the bottom line due to operating leverage. US growth by indicators, hard data versus soft data now starting to converge, i.e. the soft data is catching up to the hard data. Euro versus US dollar breaking out to new highs. That was on no one's bingo card at the beginning of the year, except the loyal, incredible listeners of Hedge Fund Tips with Tom Hayes. US natural gas combined cycle capacity in by initial operating year. What's the plan is to bring on supply. By then we will be out of Comstock Resources. In the meantime, you will be in a deficit, and Comstock will continue to do well for the foreseeable 12 to 18 to 24 months. Planned U.S. natural gas combined cycle capacity through 2028. Retail outflows from U.S. equities amounted to $29 billion last month. That's interesting. I'm not sure where they're getting this data because some of it's conflicting, but according to this data set, they were doing exactly what they did at Q4 2022, which was the buying opportunity of the century. I think this is inverted based on the other data that we look at, but either way, if you look at the consistency of the data, what it says is you wanted to be a buyer when this was happening in the past. Figure 23, retail flows into European equities, market implied Fed funds rate by, well, this is now outdated because as of today, it went to 2 for this year, back to 2 already, as the 10-year yield came down to 436. Housing affordability by state, you can see here. And the ones that were kind of towards the extremes, Florida and Texas are the ones that are starting to get hurt already. I think California is going to experience it next. And, I see subtle signs. They're $2, $3 or $4 million houses around the corner that were just built, knockdowns, everything down by the beaches and knocked down, rebuild. And they're beautiful, modern, white, 4,000 square feet, whatever. And they're both white. And rather than lower the price, the guy who built them is painting the front of one black. And my wife was like, that looks worse. I wonder why he's doing that. Why he's doing that is because he's in delusion. He thinks that it's not selling because the color is not the right color. It's not selling because the price is too high and the marginal bid is coming out of the market. And I think we're going to see an air pocket, and that's going to create a lot of opportunity. So S&P index based on the bull-bear spread. Again, this is what you see at lows. Everyone's buying puts in the, this is the institutional investor bull-bear spread. And then it's not even, we're not even at the overbought level. Like if you look during COVID, it gets overbought. And then everyone said, here, we're going back down to retest the lows. Or here in 2022 after the lows, and then you get this little check back. We're not even ready to get our major check back. I think we go back to new highs and then we get our check back. In 2016, same thing. We're like here. We're early stages of the recovery. Early stages. When you get up here, you still get more gasoline in the tank. So there's a lot of stuff to do. And that's why I've been so aggressive about getting people deployed in the types of stocks that we're doing now before, 4, 5, 6 months from now, we're up here and everything's already up another 50, 60%. Risk appetite, over the next 30 days, still subdued. That's when you want to be buying correctly, picking stocks, not buying the indices, which have moved. China net EV sales continue to go up. That's helping Albemarle. Prime book of global equities, net buying. These have been forced chasers, but off of every trough, you get the forced chase, which is followed by at least a year plus of follow through. US IPO market. This is going to be the next game, Animal Spirits. You're seeing it with Circle IPO and a couple others trading well above issue price. There's huge pent up demand for Animal Spirits. That should help the banks a little bit. This is the stuff that Trump is gutting, is the regulation around building houses. Right now, it takes 122 days to build a 750,000 square foot data center. It takes 122 days to build a 1,700 square foot starter home. That should not be the same approval process or red tape. Hedge funds are still short in the hole. They're just now getting positive. They're going to have to chase a lot more. Institutional clients, same thing. Retail, who have been right. They were buying in the hole in 2022. This is the correct data from Bank of America. That other Barclays stuff was inverted. They actually published it incorrectly. They were buyers and they've been right since COVID, and they're buyers now and they're going to be right again. So we covered the Slumer. Let's just do some quick market stuff I wanted you to pay attention to here. After these spikes, you would think that the rally's over, but it's usually an indication that it's just beginning, and that's the same thing that we're seeing right now. That was the equity put call ratio, 10-day moving average. Here we've got the 1% EMA of advanced decline ratio. Again, coming off the mat. Cumulative volume ratio, mid-level. Again, these are not at extremes where you want to be a seller, even though we've had this huge run. This just coming off the mat. Look what happened in 2023, 2024, right after this. Huge follow-through, huge follow-through, huge follow-through, huge follow-through. Going all the way back to 2016, huge follow-through coming off these levels. So I know it's hard to believe because you look at earnings and 21 times and blah, blah, blah. Just know that there are so many trapped bears and so much short interest that they're going to continue to rip their faces off. And remember what I've been saying, but you heard from Lutnick more importantly this week, that they're going to have a slew of deals over the next few weeks announced. And that's going to hurt all these people that are off sides. And that's going to benefit all of you who've been paying attention and getting positioned and just minting money. So NASDAQ up, down on balance volume oscillator. Again, it's like, oh, I'm too late. Well, that's what happens off these huge drawdowns. And this is what you get. Yeah, maybe you get a little check back to scare everyone, but don't worry about it. It's early days coming off of that type of a drawdown. Going all the way back every single time. Burke high low, same thing, not extreme. Real estate, still opportunity. CCI, we covered this week. Healthcare, still huge opportunity. We got a couple names we've covered, the Baxters, the XBI, etc. And then McClellan Summation Index, again, not really yet at extreme, and similar to what you see coming off these big drawdowns with a lot of follow through to come. National Association of Active Investment Managers, not back up over 100 yet. PMO by all is a little extended, so that's why we're seeing a little chop. PMO by Dow Jones, same thing. SPX, same thing. So a little bit of chop we're seeing, and that's kind of part of it. But I would not get negative yet. I think there'll be a time to do that. There'll be a little cool off in the fall. But even then, if you're not at intrinsic value, you just ride it out into the fourth quarter where you get your year-end rally. PMO, here's the bullish percent S&P. Yeah, it's a little stretched, but it happens after every big drawdown and you get follow through. That's where people get faked out. I will say this is, if I had to give the keys to the kingdom, that very few people understand, is when you get these massive 20% drawdowns, everything looks overbought after the initial rally. And all the people who sold into the hole when Paul Tudor Jones was saying we're going to get another 50% correction after the 20% correction, and Ray Dalio was saying get out of stocks at the bottom. now that they're up 20% off the lows and everything looks overbought, now the people who got in like 3% ago, after the whole move up that were wrong at the lows, it's all psychology. So as we push up a little bit more, the first 3% pullback we get, they're going to get shaken out again. And that's going to be the next rip your face off leg to the upside. And that's what fakes people out, is after the big drawdowns, when everything looks overbought on the recovery rally, there might be a little bit of pullback just to get out the Johnny come latelys, 2-3% to just scare them out, because they're weak money, because they're already at losses because they sold low. It's the fuel for the next leg higher. That's what I'm telling you. McClellan Oscillator, again, this is not extreme. NYSE McClellan Oscillator, it's tough to top at these levels, especially coming off that type of correction. So we continue to be excessively constructive. New highs this summer. Ant International and Ant, now some headlines. Ant International, Ant Digital to seek stablecoin licenses in Hong Kong. Game is on. Alibaba's Joe Tsai says open sourcing its AI models will boost the firm's cloud business. They're number one in cloud. Trump says deal restoring China trade truce is done. Everyone bet against that. They were wrong. Yeah, there's some open ends, etc. The key is that the volatility is done. The rules of the road are clearer and businesses can start to plan again. JP Morgan lifts yuan forecast on easing tariffs risk. We said this was a critical component for Chinese equities recovery. Yes, they're up huge off the $60 lows in terms of BABA, but it's the first leg of the first leg, ladies and gentlemen. And you're going to start to see the yuan appreciate now that this trade stuff is mostly figured out. And you're going to start to see inflows into China equities in the back half, and probably starting very soon, if not now, this month. For seasonally, this is a strong month for Chinese equities. So let's see if that holds true this year as well. Chinese stocks in Hong Kong enter bull market before U.S. talks. Global investors are underinvested in China, though may express interest, says Morgan Stanley. Remember, Morgan Stanley was the sell side that was downgrading BABA in the hole at $80 and $60, and then it went straight up to $120. They were still had a $60 price target. Now that it's doubled, now they're saying maybe they'll express interest. Well, at $200, I guarantee you Morgan Stanley will be upgrading Alibaba and putting a $300 price target on it. Mark my words on that. Is China, and by the way, I'm not picking on, it's just the way it goes. Opinion follows trend. It's human nature. There are a few people that have genetic defects like me that just see things a little bit different and are willing to take that short-term pain when things are out of favor. Those folks do not wind up on the sell side. I can assure you that. The sell side are a bunch of Momo guys that follow the trend and save their jobs. So is China reversing its uninvestable image? You bet. Besant says $2 trillion reasonable for dollar stable coin market. A lot of demand. PayPal seeks to launch USD stable coin on Stellar. This is only going to enhance. They're the sixth largest stablecoin issuer right now. They will be a beneficiary. That was not even on anyone's bingo cards when we got involved. PayPal continues to climb. That thing is generating so much cash. It's going to buy in 20% of the float over the next 2 years. Transaction margins going up. Free cash flow record. It's just on a tear, and Alex Chris is crushing it. So again, in positive sign for you, a 10-year Treasury auction was strong again, in positive sign for U.S. assets. U.S. core inflation rises less than forecast, and Jay Powell continues to sit on his hands and suck his thumb. U.S. payrolls increased 139. Okay, you also had a big downward revision last month. Here's the trend that I'm showing you guys. This is showing weakening. This is deflationary, not inflationary, deflationary. Okay, so you got to get ahead of that, not be too late. Powell with his transient nonsense again, and because it's too costly to bring a country out of deflation, especially when you have no dry powder and you got so much interest service on the debt, you got to bring that interest service down like they did following World War II when debt to GDP was 120% like now. They brought it down to 63% by the mid 1950s. And they did that by letting inflation run a little hot. So you inflate a little bit of that debt away and letting growth run out of control. Inflation 3 to 5%, GDP plus 5%. And you bring that rate down from 120 down to 60 within 8 to 10 years. We can do it again, but we just need the right actors in the seats. And so far, we're missing one at the Fed. Disney takes full control of Hulu for billions less than Comcast wanted. Yeehaw, baby, we love our Disney. Theme parks generate $67 billion in annual U.S. economic impact. We love that. No one wanted it at 85. Everyone's starting to like it at 115. It's going higher. What stocks do best when the dollar weakens or strengthens? We covered that through the other charts anyway. Investors pull out of U.S. stocks and into Europe and emerging markets. Was on no one's bingo card the end of last year, except for all of these incredible hedge fund tips with Tom Hayes. Mug bearers, hat wearers, T-shirt wearers. I'm sorry, the golf shirts are still out of stock. We had a tremendous amount of interest in those. The T-shirt is actually even nicer, but they're all great. B of A's Hunter expects more emerging market gains as dollar drops. Amen. Hallelujah. Boeing books 303 new orders, hits 737 max production target in blockbuster May. Look, the business is doing great. We don't know what's going on with India. That was sad story, obviously, pray for the families and the victims, et cetera. But that plane was built in 2009. Okay. So that's before the salesman was running the shop and blowing things up, prior to Kelly Ortberg. So I wouldn't make too much of that. If it proves to be Boeing's fault for a plane that's 16 years old, they'll have to write a check, but it doesn't change the fact that all the other stuff is humming. I would say it's Air India. My bet is that there was a flaw in the maintenance versus the plane itself. Maybe parts that should have been replaced had not been replaced, or maintenance was done improperly, but we don't know until we know. So as we always say, better to be lucky than to be good. 2 weeks ago, when I said we took off the options, had made too much money too quickly from, the stock going from 135 to 210 in a matter of a couple of months. We took those off, but we didn't sell one share of stock, and we're comfortable holding every single share. We have not sold a share, but we were luckier than anything to sell all those options at huge profits 2 weeks ago. And even if we get some short-term volatility with this on the stock, we're comfortable owning it for the long term for all the reasons we've discussed. Namely, they are still a duopoly. And if you want to get it from Airbus, go for it. You can just wait 20 years for your next plane. Get to the back of the line. Small cap stocks are underloved. Why? Their time may be coming. That's from Jack Hugh. Jack is a incredible writer at Barron's, so you can check that out. Also, probably a listener of the podcast, although I can't confirm that. I do know there are a few over there that listen. U.S. power grid getting critically tight. Time to consider backup power at home. Backup power, aka the Kleenex of home standby generators, Generac, which is also going to benefit from lower rates, which is also going to benefit from the housing theme, which is also going to benefit from hurricane season coming now. Surging electricity demand is just one reason natural gas looks so appealing to investors. All the themes we've got covered. The genius trade nobody wants, stock market and sentiment results. Time for a rotation this time of year with the Stanley Cup playoffs in full swing. I'm reminded of one of the key frameworks we live by at Great Hill Capital. It comes straight from the great one himself, Wayne Gretzky, who famously said, skate to where the puck is going, not to where it has been. This, by the way, for the new people listening, you can find our article of the week at hedgefundtips.com. Just scroll down to popular post and you can just click on that there. This kind of framework isn't exactly popular in today's investment world. More often, we see investors chasing the shiny objects, aka the names making the headlines that are already up 5x and suddenly being called, quote, great buys. We prefer the names that no one wants, the ones left for dead, and we've built a long track record of doing just that. Whether it was energy during COVID when oil prices went negative, big tech in the fall of 2022 when everyone was calling for a recession that had already come, or banks and real estate after the mini banking crisis in 2023, we skate to where the puck is going. Even this year, look at Boeing. Just a few months ago, no one wanted it in the 130s. Now at 215, it's all anyone wants to talk about. So the question today is, where's the puck going next? That brings us to one of our favorite themes right now and the topic of this week's article, housing and rate sensitives. The consensus view is that rates will stay higher for longer, and anything rate sensitive, especially housing related, is left for dead. We're happy to take the other side of that trade. What I'm about to say is something you won't hear anywhere else. By the end of 2025, we expect to see 30-year fixed rate mortgages below 6%. When that happens, you will see the beach ball of pent-up demand held underwater for the past 3 years finally explode higher. At that point, housing-related stocks and cyclicals will be the talk of town. So with mortgage rates currently sitting at 6.85, how do we see a path below 6% in the next 6 months? Treasury Secretary Scott Bessent has a couple of arrows in his quiver that address that question, two of which we will highlight today. First off, the supplementary leverage ratio, aka SLR, introduced after the great financial crisis as part of the Basel III reforms requiring banks to hold a minimum capital level relative to their total assets. Scott Bessent has argued, and Jerome Powell has actually agreed that because the SLR does not factor in risk weightings, it effectively penalizes banks for holding U.S. treasuries. Bessent has called loosening the SLRs a high priority and proposed exempting government-guaranteed securities from banks' total assets. Regulators are reportedly very close to making the change, with an announcement possible as early as this summer. Bessent estimates that the exemption could free up as much as $2 trillion in bank balance sheet capacity, creating an overnight surge in demand for treasuries and lowering yields by 30 to 70 basis points. Here's a great interview from a few weeks ago where Bessent goes over the SLR around the 13-minute mark, followed by an article that explains the change in detail. So you can read through that at hedgefundtips.com. The Genius Act and stablecoins. Buffett has always preached the importance of staying within one circle of competence. It's a principle we have long followed, staying in our lane by focusing on high-quality businesses when they are temporarily impaired and sitting tight until they reach full value, i.e. our edge is time arbitrage. But even old school equity guys like myself are starting to get excited about the potential impact of digital assets as it relates to demand for treasuries. Here's why. Right now, the stablecoin market sits at roughly $250 billion, but remains largely unregulated and lacks any formal legal framework. The Genius Act, currently under review in Congress and possibly headed toward the Senate floor as soon as next week, would change that. The bill would require issuers to fully back stablecoins with high-quality liquid assets, including U.S. Treasuries. If passed, the estimates suggest that stablecoin market could grow to more than $2 trillion by 2028. That kind of growth would create near overnight surge in demand for treasuries. So you have $2 billion from the SLR, $2 trillion from the SLR, $2 trillion from stablecoin passage. You're talking $4 trillion in demand for treasuries. That's serious demand that will compress yields. That kind of growth would create a near overnight surge in demand for treasuries. Bessent estimates between $1 to $2 trillion in incremental demand could materialize over the coming years. Even if those estimates are cut in half, you're still looking at a major tailwind for lower rate compression across the board. Here's a good breakdown of stablecoins and the Genius Act straight from the Treasury, etc. Stablecoin issuers could be one of the largest holders of U.S. Treasuries by 2030, more than Japan, more than China, more than the UK, etc. Oh, and by the way, not only do our rate-sensitive plays stand to benefit as yields come down with the Genius Act, but we also own PayPal, aka the issuer of the sixth largest stablecoin in circulation, now approaching 1 billion market cap. QXO update. QXO is up 65% since we talked about it on Fox Business a couple months ago. On April 4th, you can see the video here. It's up much more since we originally covered it on the podcast. A few weeks ago, Brad Jacobs laid out his blueprint for turning QXO into the $50 billion powerhouse he envisions. His 5-year plan includes more than doubling EBITDA and driving over 500 basis points of margin expansion. In fact, his expectations for earnings upside for Beacon have materially increased since closing the deal. For us, QXO is a classic example of betting on the jockey. Brad Jacobs has a track record that speaks for itself. An investment in XPO when he got involved would have been a 50 bagger. United Rentals would have been close to a 70 bagger. Altogether, alongside Jacobs across his companies, including United Rentals, Waste Management, have generated more than 300 times investors' money. On top of that, Brad Jacobs also puts his money where his mouth is and has some serious skin in the game with QXO. He wrote a $900 million check out of his own pocket and now owns 28% of the equity. The rest of QXO's leadership has material ownership and incentive plans tied to stockholder returns. This is the kind of position we are happy to buy, throw in a filing cabinet, and watch Brad Jacobs work his magic over the next few years. We think over the long term, this is a 5 to 6 bagger. Knowing Brad Jacobs, it could end up being much more. Here's the full QXO investor presentation, which does a good job laying out the playbook for how Jacobs plans to build his next masterpiece and disrupt the building products distribution industry. Safe to say we are excited to be along for the ride. You can go through that at your leisure. Wolf Research put the $44 price target on the stock, 162% upside. That came out just a few days ago. So when we were pitching it at $13 and lower, it went to 11 against us after we bought it. Everyone said, you're an idiot for buying it at 2 times cash, blah, blah, blah. I said, idiot I am. We bought more. Now it's at 20, going to 50, going to 100. So bet on the jockey is the name of the game. Now, the reason housing is one of our favorite themes isn't just because it stands to benefit from lower rates. We've also discussed the strong demographic tailwinds, peak family formation in the 30 to 35-year-old range group, improving affordability driven by starter home revival, multi-million unit housing shortage, and opening up of federal lands, all supporting our thesis. Apollo put out a great housing outlook note a few weeks ago, also highlighting some of these tailwinds. You can see the affordability at record lows, not seen since the early 2000s. Demographic tailwinds are a tailwind to housing demand. Median age of all home buyers is now 56 years old, up from 31 in 1981. This is like an extreme that will revert very, very quickly. Total housing inventory per person is very low. U.S. has an estimated deficit of 2.4 million homes. U.S. homes are getting smaller. Median size of new single-family homes is declining. We said this would start to happen 2 years ago. It's now happening. The whole game is going to be on. You see this going back to the early 2000s, and then it just picks up. This is the fastest Fed-driven housing slowdown on record. Let me repeat that again. This is the fastest Fed-driven, i.e. legacy, personal legacy, selfish interest, Fed-driven housing slowdown on record. Next week, I'll tell you how I really feel. Crown Castle update. This is also interest rate sensitive. You can see the free cash flow here. You can see the price. This is going to revert back. It's all a function of rates. In the meantime, you pick up a 4% dividend yield. You can read through the earnings. At the end of the day, here are the key points you need to know about Crown Castle. One, it's going higher in our view, a lot higher. Top priority remains closing the $8.5 billion sale of its small cell and fiber solutions business in the first half of 2026. Management continues to make solid progress working through the regulatory approval process. Once completed, Crown Castle will become the only publicly traded pure play tower company focused exclusively on the U.S. Management continues to expect annual AFFO in the range of $2.27 billion to $2.42 once the transaction closes. Compared to current outlook of 1.7 to 1.8, the increase is largely driven by anticipated reductions in interest expense and significantly leaner cost structure of the standalone business. 3, management expects to repay $6 billion of debt with the transaction proceeds and allocate up to $3 billion towards share repurchases, roughly 7% of the current market cap. 4, organic revenue growth came in at 5.1% in Q1 ahead of the 4.5% full year guidance. Management reiterated guidance across the board and noted they were tracking towards the high end of the range and may even expand it as the year progresses. Mobile data demand continues to grow at a strong clip with the rollout of 5G networks. CCI's customers have invested over $35 billion annually into their networks, helping to drive more than 5% organic growth in the tower business. Conversations with customers remain constructive, and growing competitive pressure among carriers continues to be a strong tailwind for tower companies. CapEx, a long concern for capital-intensive fiber business since it accounted for nearly 90% of the spending last year, totaled just $40 million this year, only 4% of revenues compared with 20% last year. With the U.S. tower business requiring minimal CapEx, capital allocation will begin shifting toward returning capital to owners. Consolidated adjusted EBITDA margins for the quarter were 68%, a 500 basis point improvement year over year, as highly attractive tower business is no longer held back by the fiber and small cell segments. 8, Sprint churn should largely be done by the end of 2025, with management continuing to expect long-term churn rates of just 1% to 2%. 9, management remains committed to maintaining an investment-grade balance sheet with an average maturity length over 6 years, 89% fixed rate debt, and long-term average targets of 6 to 6.5 times EBITDA. And 10, beginning, I feel like I'm David Letterman, top 10 list. Beginning in the second quarter, management reduced the dividend to 4.5, still yielding 4.27% at today's prices. This new quarterly payout is expected to run at a rate of 75% to 80% of anticipated AFFO. Okay, closing out the article, our sentiment, even Morningstar still has 125 fair value. It's going higher, a lot higher than that. Sentiment is up there, still not yet extreme. Same with active investment managers, exposure still not fully at extreme. Consumer staples earnings revisions last 60 days, rear view looking seasonally weaker, which is normal. They bring down estimates the first half, they ramp them up the second half. They're down 2.45 and 2.75% respectively. It's already in the stocks. Defensive have sold off. We're probably at the trough there. Consumer discretionary down just 33 basis points for this year and 1.06 for next year. So those are holding up. Some of those have run ahead of themselves. I think that's the shift we're also going to see in the next quarter. Let's just look at this inflation data. Came in headline below expectations at 2.4%. Month on month, only 10 basis points up. And then today you saw PPI, a similar story, expected to be up. Core was expected to be up 0.3%, was only up 0.1% year on year, 3% versus 3.1 estimates. And PPI was supposed to be up 0.2% month on month headline, and was only up 0.1%. So Powell, wake up and smell the deflation. Disinflation, I'd say. You keep it up, it'll be deflation. And by the way, very unpopular view, but you do not want this to catch up, because once deflation starts, you can't stop it. Inflation, you can stop in 5 minutes with an emergency hike. Deflation, it'll cost trillions, and a lot of heartache and unemployment just so the guy can get his legacy guaranteed. All right, so earnings. They've taken down estimates for Q2. I love this because the bar is low. At the end of March, Q2 estimates were 9.3%. They're now down to 4.9%. So they set the bar low so they can step right over it. They will beat this just like they did in Q1 when they took it down to 6% earnings growth, and they actually did 13.3% earnings growth. This, my guess is, it's expected to be 5%. It'll probably be 9 or 10%, and that'll be enough to get us to new highs before we probably take a breather in the fall ahead of the year-end follow through. So that's that. The podcast is over. Now we go on to the Ask Me Anything questions from our amazing audience. So if you like to stick around from that and you learn as we go through individual companies that the audience is asking me to look at, please stick around. For the rest of you, we'll be back next week, same time, same place. So here we go. Okay, question 1 comes from Austin McVan. Wanted to know your thoughts on SAIA. Let's take a look. to sign in here. Well, that does that. Let's bring it up here. SAIA. All right. I have a feeling this one's going to be good. Let's take a look. Ooh. What is going on with the negative free cash flow, my man? Yeah, let me take a look at the balance sheet. I'm going to say probably a pass on this until I see a quarter of break-even cash flow. But let's take a look at the $19 million of cash. Long-term debt, 194. I'm not sure about this one. So you're saying stock crash due to weather? Stock doesn't crash due to weather. Stock crash due to mismanagement. You got a lot of negative free cash flow, partner. Tariff uncertainties? No. It's not time yet. Wait till they get a quarter of positive free cash flow, and if the stock is still down, jump on it. If it's not, if something is not good here, okay? So I want to understand their turnaround story, and then I want to see them execute on their turnaround story. But for right now, it's just a bleeding raccoon on the side of the road. David Berger asked for thoughts on Carvana short. Yeah, look, I understand what you're saying about Carvana, but the problem is they're generating a lot of cash. So the question is, do you want to short on valuation alone? Good luck. You might be right in the short term. Maybe it's overbought in the short term and you could do it as a 5-minute trade. But what is this thing? $68 billion market cap on $1.5 billion of EBITDA, 4 times sales, 60 times EBITDA. Balance sheet's okay. They got a lot of cash. If you look at the enterprise value here, is that correct? They got $20 billion of cash. Yeah, I wouldn't be shorting a company with $20 billion of cash. What do they have? 13. I don't know. You really have to be convinced that the business model is toast. I don't really know anything about it other than I wouldn't short on valuation for this one. Brendan Garvey. Love the pod. Current finance student who's considering the CFA. Any thought on the program, current state of value as it adds value both to the person taking it and the reflection to employers? I would say if you're coming out of school with no world experience or investing credibility, it's indispensable. Like you have zero value without that information, more or less. So I would, unless you've run a business for 20 years and, you understand financials like the back of your hand, I think it's absolutely indispensable. And it has nothing to do with, should I get it to look good to employers? You should get it as an investment in yourself and in yourself only. So I think it's absolutely indispensable. I mean, if you had an MBA and you're like 30, or you'd run a business for 10 years and made, 10, 20 million bucks, and, you understood financials and you understood businesses and you've been investing for 10 years on your own and pretty good at it, it's probably not the highest and best use of time, but at your age, it's without question That's table stakes. And then you may still not succeed. You may still not get hired. It does not give you a right to a job. It gives you an opportunity to a job. But without it, unless you're at one of the Ivies, I think your odds are low. So I would do it for yourself first and foremost. Your employers will see it as a commitment that you're not just entering the career because you think it's a way to make money, but you're entering it because it's what you actually want to do. And I think you're on the right track. So thanks for putting that in, and I'm sure that helped a lot of people. Johan Hagenbjork. Hi, Tom. Johan Hagenbjork. Okay, these are my guys in Sweden. A question from another member of the Swedish investment crew, quote, Beer and Baba. These are my fans in Sweden that have been tuning in for the last couple of years while we built out the Baba position. I hope your basis is below 85 and you're making money, and you're going to make a lot more money and be able to afford a lot more beer. Here is your, and hopefully you're buying it from Guinness, sold by Diageo. What is your opinion of the off-road vehicle company Polaris? They are a dividend aristocrat meeting headwinds from macro demand. Look, this is another rates play. I think we're getting close. I was looking at FOXF this week. I generally hate these businesses, to be honest with you. They're garbage businesses. But I think at this level, you're probably right. Let's take a look at the financials. As a matter of fact, this might even be on my, we have like a 2-page list of targets that we do constant work on. And maybe out of 60 names, 1 or 2 will make it into the portfolio within 90 days. Let's see. I think this didn't make it only because of the reason I hate the business, but I think you're going to be right on this one. I mean, revenues are really collapsed here. Margins collapsed. Let me see the balance sheet. I mean, if rates come, yeah, I mean, this is just another rate play, and I don't want to be overweight rate plays, but all right, they're bringing the share count down. Yeah, I mean, the cash flow was really light last year. Let's see what it is on a quarterly basis. I like it, Beer and Baba. I like it. I like it. I think you're going to be fine. I don't think I'll do anything with it, but I do like it. All right. Theo. Wanted to come. Yeah. All right. So this guy is like asked us about BTMD. And then one of my clients, who's a wealthy OC guy, said like everyone's taking it and it's causing a lot of divorces because apparently it makes old guys feel super duper young and act super duper young, if you catch my drift. Is this the one? Let me just see. Hormone optimization. Hormone replacement pellet therapy. Bio end-to-end. So apparently this stuff works. And there's maybe only one supplier. Yeah, we just don't do individual biotech companies because we don't think we have an edge, and we stay where we do have an edge. But I think on a financials basis, if you think you have an edge on the product and you feel damn comfortable that the moat is impenetrable, then have at it. Question is how bad are they going to dilute you over time? And you have no way of telling. They've gone from 1 million shares to 35. What's to say they won't go to 100? So it might win, and management are a bunch of scumbags, and they give themselves unlimited amounts of options because they got the board in their pocket. I would spend all of your time studying the history of the CEO. And what has he done for owners in the past? Because he could have the best thing in the world and you could be right about the product and you won't make a dime because he puts it all in his pocket. And you see that a lot with these type of companies. So investor relations, governance, executive leadership. Brett Christensen. Let's see what this guy has done. Myriad Genetics was a disaster, if I'm not mistaken. MYGN. Yeah, train wreck. Holix, HOLX. When was he involved there? That looked like a success. And pod. All right. Drove significant revenue growth. Utah Valley. He has a bachelor's from Utah Valley Business School, no medical background. You better do a lot of work on this one. That's all I have to say. So I'll leave it at that. I think you're going to be right about the product. The question is whether you're going to make money off the stock. And I don't know. And that's why I don't do individual names like that. Hey, turnaround time. I have a question. Could you look at IPG? It's not even down 50%. So it's not that interesting to us, but let's take a look. I'm sure the balance sheet is okay. Revenues have been declining for 4 consecutive years. $4.2 billion of debt. Oh, they've got $2 billion of cash, so that's good. $1 billion of free cash. That's pretty damn good. I'm sorry. Revenues have not been declining. Flattish. All right. Share count's coming down. I mean, it's worth exploring. I don't like that kind of business, but I mean, if you want to take that risk for 50% move over 3 years, it's not going to be a high enough IRR for us, and it's just not attractive enough. I don't really like that business, so I don't think you'll be wrong, but I wouldn't get excited about it. Krispy Kreme, this has been a perennial disappointer. Let's see if they're not. They might be so low if they don't. Oh my God. Stock is just getting destroyed. Weren't they supposed to have a deal with McDonald's? What did that fall through? Is that the problem? Donut, DNUT. No, there's nothing here. I mean, this thing's just losing cash hand over fist. No matter how cheap it is. Let's see if the balance sheet, let's see if you can even live to watch it turn around before they restructure it. 29 million of cash. Share count's gone up by 50% almost, or 40%. How much debt? $800 million on 29 million of cash. You got, so it's trading like it's going out of business, like not out of business, but bankrupt, and they'll have to, the debt holders will own the company. Free cash flow negative. They've never really generated returns on capital. Look, I think this is a trade, Jason. I mean, I can see the attractiveness of it. I think Krispy Kreme will always be in business. The question is, will you own it, or will the debt holders own it? And some risks are just not worth taking. I think this is one of those. And even if it triples or quadruples, I would have zero. Errors of omission are okay. Errors of commission, like taking a binary gamble on whether a company goes bankrupt or not, I don't think is the best use of capital. Johnny S. is asking about Meituan. I don't like Meituan. I like Baba. I think Meituan could go the way of Grubhub, and all the Me Too's. I just think that it's too crowded, and even if it works, I think it's a commodity business. I need a lot more outs in China, and I have it with Alibaba. I don't want to take China risk and take company risk. Meituan has never been for me. It's not for me. Doesn't mean it won't go up when all of China goes up. I just don't want to take that risk. Anton Ellerman. What are your thoughts on Regeneron? There are rumors a new Ozempic drug in development that will add protein and lose weight. Look, I like Regeneron, but I don't buy individual biotech stocks. So it's cheap enough, and it's quality enough, and management is good enough. It's become very bureaucratic. That's also slowed it down quite a bit. I think you're going to be right here, but I'm not going to be involved with you. I've looked at it a million times and I just can't get there. But if you put a gun to my head and said you got to buy an individual biotech stock right now and hold it for the next 5 years, it would either be this or Biogen, and I haven't done enough work on either of them. So, but I don't have to, so I won't do it. And let's just take a look here. I mean, they got more than enough cash for the turnaround plan to pay out. So this drug better hit, because their revenues have just been declining. So I wouldn't bet against them. And I think at these levels, if you had to go into an individual biotech, this might be one of them, but you don't. So why would you? SNN, this is from Chris Williamson. It's a UK medical device worker, medical device. Yeah, it's just not down enough. It's like you're not really going to make a lot of money for taking any risk. It's got to be a double or triple for me to get involved, and this one hasn't come in enough. So yes, cash flow is recovering. Yes, it probably trades back up to 45, so you'll make 50% over the next couple of years. Let's look at the balance sheet. I think there's a lot of things to do in medical devices. They are left for dead. I think the balance sheet's okay here from what I can see. Got to double check it with source materials. I think you're okay. I just don't think you're going to make a ton of money. I think you're going to make a little bit of money, and I don't take risk for a little bit of money. Lyle M, Puma. I think we covered this. VF is a better play because you have more outs and more ways to win. I don't really know the brand. I don't like the brand. I mean, other than Ricky Fowler, I don't know anything about the brand. So this is a European thing. I stay within my circle of competency. This is not within it. And if I was going to buy another sneaker company, I'd be buying Nike all day long. That I understand. That I think is a buy. But I don't like the upside as much as I like it in VF Corp when Bracken turns it around. So I'm going to just say I have nothing to say on this one. Not good, not bad, just nothing. Lee Foster, BME on the LSE. This is an ETF, isn't it? No, it's not. General merchandise and grocery stores. Oh, is this like a Lidl's and like those low-cost supermarkets? Yeah, I mean, this reminds me of Tesco, which got smashed, that Buffett owned. But billion pounds of debt, cash flow. I think this might be interesting. I would have to understand the business more, but I think you're on the right track. I'd read the annual report, listen to the last 8 earnings calls, start to understand the turnaround story. What's happening here with revenues? I think it's interesting. I'm actually going to write it down and maybe do a little work on it. UK play, which I'm kind of interested in. Good work, Lee. Michael Silber. Is it okay for a company's share count to go up due to an acquisition? Well, it depends if it's dilutive or accretive. And what does that mean? Is the multiple of the company that they're buying lower than the multiple of the stock that they're issuing? And then is the growth rate as fast for the company they're issuing versus their current shares? And then see what is the synergies, what do the synergies look like? So if I'm issuing stock at 30 times earnings and I'm buying and I'm growing at 10%, and I'm buying a company that's trading at 15 times and growing at 10%, I should probably do that all day. And then if I can add some synergies on top of it, fine. I prefer debt financing if they can do it at reasonable rates and not dilute at all, but in that arbitrage. But if I'm growing at 30% and trading at 10 times, and I buy a company that's growing at 20% at 20 times, and I give stock, I just diluted my shareholders. So the answer is it's not an easy answer, but I tend to not like it. Love your podcast. From your experience, do you think the VF Corp investigation from Levi and Korsinski would negatively affect the stock? No, these are a bunch of scumbag ambulance chasers that just sue every stock that the price is down and hustle them for payoffs. And it's just a friction in the economy because unfortunately we're not in a loser pays system. And it's a cost of doing business. So these happen. Any stock that the price goes down more than 30%, these ambulance chasers file a suit and hope for a payoff. And they usually get it, which is why they keep doing it. And hopefully that's something Trump can change. But in the meantime, it is what it is. And no, it'll have zero impact if they even have a case, which they don't. All right. Thoughts on Domino's Pizza Enterprises in Australia? The Qataris, I think, just offered to buy Papa John's, which was a super cheap stock. Yeah, I think with this one, all you got to look at is the margin of. Let me take a look at the revenue income statement here. I mean, the revenues have really been anemic, so I want to understand why that is. There's no growth. So explain how they're going to reaccelerate growth. It's just steady state. They should just be buying in stock, and they're not. Let's see if we can figure out why. They've only got 58 million in cash. A little bit of leverage on the balance sheet. I think you're probably okay here. I kind of like it, but do some real work on it before you buy anything. But generally, seems like an okay find. And thanks for sending it in, Dylan Cook. Thanks for your podcast videos. Take a look at Owens Corning. Yeah, we covered that one a few weeks ago. I think we said so. Yeah, it hadn't come in enough for us. So I think it's okay, but I wouldn't be a buyer here. I'd probably be interested below 100, and it may not ever get there. And I won't care one bit if it goes to new highs without me. But it wasn't compelling enough for me at that level. It's okay. It will benefit from the housing. It'll probably be fine, but I need a double or triple, and I don't think I'm going to get that anytime soon on that. Thank you for your content, valuable knowledge you always share on online and on TV. ACMR. I'm personally long the stock and see 34 to 40 as a good target. Okay. On what basis? ACMR. All right, looks like they're just starting to generate some cash. Revenues are growing. Revenues are growing very fast. Share count's growing a little bit. What do they do? Manufactures and sells capital equipment, packaging tool and wafer assembly and packaging customers, front-end production, wafer surfaces. Shares outstanding. 2 times sales, 10 times EBITDA, 16 times earnings. I don't know. I mean, I would never buy a stock at $25 for an upside of 34 to 40. But it seems okay. It's okay. I just think there are higher and better uses from these levels, but I'd have to understand the business a little bit more. Professor Tom, do you keep it this from Jimmy Jones? Do you keep a certain percentage of cash in your portfolio from a sale, or do you immediately deploy into equity that are still undervalued? I know, opinion, not advice. Okay. It depends on the opportunities. Like right now, I could deploy a huge amount of capital very, very, very quickly because there's still opportunities. But that window's closing. It'll probably be closed in the next 8 to 10 weeks. So when we like the huge proceeds we had from the Boeing options, we were able to deploy that immediately. If opportunities are light, we'll just deploy into shorts, or we will just wait on cash until we find opportunities. But right now, we could deploy unlimited amounts. Like I could deploy $2 billion tomorrow easily and have plenty of opportunities to do so. I think in 6 months, it's going to be a lot harder. But there's no limitations. If there's no opportunity, I'll hold cash or do shorts. But there's always some type of opportunity because if it's risk on, defensives are in the gutter. If the market's down a lot, then risk assets are on sale. So there's also opportunities in the bond market. If you're in a real drawdown, you can do high yield. I mean, we can go across all asset classes, equities, but we're concentrated equities is where we like to focus. And there's usually something to do. We don't hold cash that long unless we see something really special happening. So I'll leave it at that. Okay, now see if we have one more, and then we will move along. KenView. KVUE. I met the CEO at the Al Smith dinner. I thought he was a spectacular guy, as was his wife. But yeah, never did anything with it. That was almost a year ago. I just don't think Tylenol, Motrin, it's all over-the-counter stuff. It looks like they have a little bit of pricing power. I don't know why the share count is going up so much. That's bothersome for a company that big, unless they did a big acquisition. Free cash flows come down quite a bit. It's halved in the last year. Let's see what it's done on a quarterly basis. I mean, this is a defensive, so it is kind of interesting right now because defensives are out of favor in some pockets. I mean, you're not really getting a bargain for a growing business. So I would just have to understand what is the growth driver, because I'm not seeing growth yet. All I'm seeing is growth in share count, not growth in earnings or cash flow or all the things that matter. So, and they're, you know, a little bit leveraged. So it's not, you know, just because the stock's down $2 doesn't get me very excited. Nothing really to do yet here. This is not a good highest and best use of capital. It's not to say it won't be okay. Grifolis, this is from Wilhelm Kunberger. GRIF. Is this a steel producer, if I'm not mistaken? GRIF. This is definitely interesting. What is it? Please don't be in the steel business. No. Oh. Plasma Therapeutic Company in Spain. Immunoglobulin to treat immunodeficiency. Again, this is wow, this is founded in 1909. Blood services, immunoglobulin. Liver cirrhosis. Oh, God. I don't know. Is this a biotech company? I mean, I like what I'm seeing. I got to be honest with you. So, free cash flow is going up. Revenues are going up. Margins look like they're stabilizing. Share count is steady. I think your free cash flow looks good. I think the risk is going to be, let's take a look at the balance sheet, $1 billion of cash and almost $9 billion of debt. That's your risk, is the balance sheet leverage. So you got to go through the public filings and find out when all their debt matures and what are the terms of their debt, how sustainable the cash flow recovery is. Because I think with everything else held equal, I think it's trading down because of that leverage and where rates are, but they're cutting in Europe. And this is a Spanish-based company, if I'm not mistaken. I think you might have something here, Wilhelm. So good job. Do more work before you do anything. Robert Wartanian. How do you like Anta Sports brand for Asia? Growing food chain from the Philippines. Asian food paired with burgers and chicken. Anta Sports. Oh, is this a Chinese company? Let's see. Successors in China. Cross training. People's Republic of China. I won't buy any companies in China other than Baba. I'm not taking company and country risk. All the numbers look great. I can give you 100 companies that look great in China. Baba's my only play in China. Only ever will be. I think the numbers look fine. I just wouldn't be involved personally. So with that said, we'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.